Welcome to Friday's webinar on Outlook on India's outperformance and its stability. This is Akshara Menon from PMS Bazaar. I work here as an analyst. Along with me, I also welcome Mr. Naveen Kulkarni, who's CIO of Axis Securities. To brief about him, Naveen Kulkarni is an accomplished industry leader with 19 years of experience in investment management, equity research, and telecom industry. At Axis Securities Limited, he's responsible for a wide range of investment management mandates, which include PMS, investment advisory, and research services. He has long-standing experience of managing diverse equity with consistent track record of beating the benchmark by significant margin. In his prior roles, as head of institutional equity research, he was also a lead sector analyst and equity strategist. He has built award-winning teams and has been a recipient of multiple awards in equity research by Thomson Reuters, Wall Street Journal, and other leading surveys. He is a frequent contributor of leading news, broadcasters, and print publishers. He is also a most cited industry expert for sectors like telecom, consumer, and equity settlement. Over to you, sir. The podium is yours. Before that, I just want to say something to the audience. Please do not ask any stock-specific questions. Let's avoid that, because that won't be taken onto the podium. And put your questions in Q&A section and not in chat box. Thank you, sir. The platform is yours now.
Thanks, Akshara, and thank you, everybody. So first of all, wishing everybody a happy Diwali. I know it's that time of the year where, of course, markets are very, very exciting to look at, but also we want to take a little bit of things little light, right? Now it's all about festivities, going to other places and distributing sweets, right? So that kind of activity is, I think, happening around. But meanwhile, what's happened in the Indian equity markets is also very, very important. So I'll just bring up my presentation. What I'll do is, I'll take about half an hour or so to talk about the equity markets, why India is actually doing well, right? So in this global turmoil kind of a situation where things look very, very challenging, India has done very, very well. The question here is whether India can continue to outperform, whether the performance that we have delivered in the last 1 year, is that sustainable? And how sustainable is that? And what are the factors for that? So I'll try and provide some perspective on this. I'll try and put up some data points which will help. And also I'll talk about some of our strategies, how they are doing in this market, how they have performed in the last 1 year, and what do we expect from here, right? So that's the gist of ideas that I'll be talking about. So without further ado, I'll just briefly run through. These are the broad points, right? We are at a fundamentally strong footing. There's no doubt about that, right? So markets actually tanked quite a bit, even from an Indian perspective. June 2022, at around 17th of June, we reached close to around 15,000 odd levels, right? From that levels, the Nifty 50 has recovered by around 15%. Both mid caps and small cap indices do have recovered by 20% and 18%, right? That's a good amount of recovery that we are seeing. Volatility index is a very important index that we track very, very keenly. The reason why we track volatility index is because it indicates the amount of risk in the market and how people are perceiving that risk. Right now, volatility index is just about lower than the long-term average. Just about lower. It's not much lower, or it's not in a panic zone for sure. So it essentially means that probably we are in a zone where the smart money is coming in. Investment styles wise, growth has actually done quite well in the last 1 year. And growth with the kind of outperformance that we have seen, it has actually outperformed value by a decent margin in the last 1 year. Momentum, of course, has gathered a lot of steam. So I'll talk about how strategies are also stacked up with regards to these and why these investment styles are important. FI and DIR flows have been very, very important. So if you actually see, FI has pumped in around $37 billion in FY21, and they have pulled out more than $27 billion in the last 2 years, right? So last 1.5 years. So essentially, there's not much of FI money which has come in post the pandemic period. So most of the easy money which had come in has actually gone out. So not much to worry about from the FI front. Q2 FI at 23 earnings as of now has been quite okay, by the way. It's been actually good. Apart from this, what to expect? We are expecting good set of numbers from Q2. More important will be how the festival season pans out. That will set the trajectory for the full year. Earnings growth has been very, very strong. Essentially, we are still foreseeing around 820 rupees EPS for FY23 and around 930 rupees EPS for FY24, right? So these are like very, very good numbers, and chances of these numbers materializing are very, very high scale. Let's look at what has happened in the Indian equity markets in the last 1 year. This is very important. Since last Diwali, Nifty 50 is down by around 2%, right? But S&P 500 index is down by 20 odd %. So we have outperformed the S&P 500 index by close to 18% in the last 1 year. It's a very, very strong indication, right? And compared to the FTSE Emerging Market Index, which is down at 29%, right? We are outperforming that index by close to 27%, right? That's significant outperformance. Reason is that it's not that we are decoupled from these markets. We are outperformed. These markets have fallen much, much more than the Indian market. The reasons are fairly straightforward. It's because of the unexpected inflation that they have seen. 8% inflation for a US market is a very high number compared to an 8% inflation for India. Because our normal growth inflation trajectory is between 5 and 6%. 5 and 6% going to 8% is fine, right? Which is like 30% higher. But it's still something that we tend to live with. We manage, our cost structures are built for that kind of inflation. But in the US market, if total inflation is around 2%, that goes to around 8%. It's like 4 times. Right? So things become very, very challenging. The level of prices becomes challenging. Nobody is built for that kind of an inflation. That's the fundamental difference. So the fundamental factors why we are actually outperforming, right? Our indices have done much, much better. I'll also delve more into the fundamental factors which are doing well. In terms of sectors, this is when the war started. Pretty much most of the sectors in India are green, except for healthcare and IT, right? Those are the 2 sectors which are actually in red. Apart from that, most of the sectors have actually delivered positive returns. That's very, very interesting. If you look at since when the war started, even things were expected to be really bad, but across the board, industrials have been one of the top performing sector. Utilities have done very, very well. Banks have done very, very well, right? Consumer discretionary has done very, very well. So that's something which is very, very interesting. So overall, things which are domestic consumption stories have done very well. So look at staples performance. They're 23% up, right? Domestic consumption themes are doing very, very well. So on the whole, when we look at the index, it's the domestic consumption theme, which is quite resilient, and that's doing quite well. Again, gold has not done well. Cyclical and export themes have not done so well. But it's banks, auto, FMCG, hospitals, domestic industrials, discretionary. These are all done. These are all sectors which are done well. Interesting aspect is the PSU banks have outperformed the private banks over the last 1 year. That's a very, very strong thing, right? It means that the overall financial health of the system has improved significantly in India, right? Most of the PSU banks were actually reeling in very high NPA stress. Right now, if we see, a lot of them have actually come out of that zone, and many have become actually reasonably efficient. So, of course, SBI, the largest PSU bank, which is almost more than 20% market share, right, is probably looking at a 15% ROE this year. That's a very, very strong indication, right? Bank of Baroda might do a 12 to 13% ROE this year. Again, a very, very strong indication. Right, so that's what is happening in the banking sector, right? So the PSUs have actually improved their health quite a bit. Having said that, while the markets have actually withstood the storm, but we see that the market, there are a lot of stocks which have corrected also. If we actually see, what is the percentage of stocks which are down by more than 20% from the 52-week highs? 58% of the stocks are below 20%, right, from the 52-week highs. So it's not that it's all been hunky-dory. At an index level or at a portfolio level, things get evened out. But if we look at it from a perspective of stock specific, wide range of stocks have corrected quite a bit. And 58% of the stocks are below 20%. And 35% of the stocks have corrected more than 30%. So 1/3 of the market is down by more than 30%. Right? So that's something which is very, very important to think about. This is another picture which gives. So we look at what kind of stocks are trading below their 200-day DMA, right? And what kind of number of stocks which are trading above their 200-day days moving average. So typically in a stressful scenario like the 2008 financial crisis, pretty much it went down to 0. 2020 it went down to 4%. This scenario, we came down to as low as 14-15% at one point in time. From there, of course, things have gotten better. But even then, right, what has happened is that right now also, we went down to as low as 18%. And at one point in time, it was probably even 14-15%. We're still below average. So it's not that market is an overbought zone. Market is in an even Steven kind of a zone. It's probably a little more, I would say that it's still lower than the 53% average in terms of what is the average number of stocks which are trading above the 200-day. It's 53%. We are 51% or 50% right now. So we are round about there. So it's not that we are in an oversold zone or we are in an overbought zone, nothing like that. So we are very much in the median kind of a zone. So we are talking about a market which is very, very logical at this point in time. In terms of investment styles, what has done well? These are the value, growth, quality, and momentum styles, right? Last 1 year, the growth style has outperformed every other style by a large margin. But momentum over the last 3 months has come back significantly. And on a 2-year perspective, momentum has been the strongest theme in the market. 2021 was the year of value because that outperformed everything. 2022 has been the year of growth. But more importantly, the stronger the growth outlook has been, it has helped in delivering significant outcomes. This is the sector-wise performance. If you see, last 1 year, autos have done well, banks have done well, energy has done well, of course, FMCG has done well. PSU banks have been the strongest performing sector. That's a very, very important takeaway. They have outperformed the banks by big time. And again, India compared to global market, right? Nifty 50 probably on 1 year basis is down by 5%. Whereas Nasdaq is down by 29%. Dow is down by 14%. S&P 500 index is down by 18% on 1 year basis. And that's significant underperformance. And we have outperformed these markets by a fairly large margin. And look at what are the sectors which are outperforming. You see, autos, these things are sustainable. Banks, it's very much sustainable because the quality of balance sheet is very, very high. And then sectors which are underperformed, like let's say IT, which is very, very similar to, let's say, Nasdaq. They're down by 25%. Nasdaq is down by 29%. Similar, right? So it's not that everything is hunky-dory in India and nothing is right. So it's essentially that there are reasons why we are actually outperforming. It's the mix of sectors, mix of stocks, so on and so forth, right? But interestingly, the IT sector results were not that bad even in this quarter. What they reported this quarter numbers are quite decent actually. In fact, they have beaten the estimates. So that's something which is very, very interesting. In terms of market capitalization, banks are now the largest. On 1 year basis, IT is down by 17%. Holistically, we are touching pretty much all-time highs in terms of market capitalization now. Of course, this includes capital raising, all those things included. The P/E ratio, we are at 1 standard deviation. On price to book, we are below 1 standard deviation. Although the quality of balance sheet is at a decadal high, the P/E ratio and is that one standard deviation in price to book is less than one standard. What does one standard deviation mean, right? One standard deviation means that essentially that this is a 34-5% zone. This is where the market rates are 34-35% of the times. That's something which it means. On price to book, we are reaching mean. So 50% of the time we would be at this time, this level only. That's what it means. Very, very interesting takeaway here. So essentially, we are not extremely expensive when it comes to P by E, price to earnings, nor price to book. We are closer to, not very, very far away from the mean, right? Market valuations, of course, when we compare ourselves to other markets, essentially, our risk, our India versus the FTSE emerging market premium has gone to almost 100% compared to 39%. Reason being, China and Taiwan, which constitute 50% of the FTSE index, are down by a significant margin. China is probably trading at 2009 levels. Taiwan is also down now, right? So those are those intrinsic problems of their markets, which is leading to the challenges. Whereas India has lesser intrinsic problem, more of problem of other aspects, which is, let's say, some bit on balance of payment, export versus import, right? Those challenges which are impacting the currency. Other than that, intrinsically, we are doing quite well. Sectorally, we see valuations. Autos are slightly expensive. IT is expensive, but banks, the largest sector, is trading at mean, not very expensive for sure. Metals are cheap. PSU banks are cheap. Energy is reasonable. Media, of course, is cheap. Services are cheap. Pharma is reasonable long-term. So we are sectorally, we are quite okay, right? Nothing really challenging in terms of valuation. We are mean only, nothing significant. And that too, I'm talking about 10-year mean. If you look at banks, if I compare banks valuation with the 10-year mean, it should be trading at a higher multiple, right? That considering the balance sheet quality is at a decadal high. PSU bank should be trading at a higher multiple than the 10-year average. But we are still trading. So that means that there is a significant improvement which has taken place. Earnings trajectory. FY09 to FY21, just 7% growth rate. FY21, even though it was a COVID year, there was 20% earnings growth. FY22, we saw 20% earnings growth. FY23, 2 quarters are almost getting done. We are still seeing good earnings growth trajectory coming. So I think these numbers are very much realizable. So we will grow at good earnings growth in the next 2 years. And that's what is helping the markets big time. This is a very, very interesting table. This is the 4 quarters rolling profitability. Right? I add 4 quarters profit of the top 500 companies. This data not many people would have shown to you guys. If I were to add the 4 quarters profit for Q1 FY23, we have crossed 10 lakh crores. Right? This number in the pre-pandemic period in FY19, if you look at Q3 FY20, right, which is the pre-pandemic period, or Q3 FY20 or Q2 FY20, at the 4 quarters rolling profit, we were at 5,23,000 crores. We are today at 10 lakh crore plus number. What does it indicate? We have grown by 4,70,000. So the total profit growth from pre-pandemic period to post-pandemic period is close to 80%. Is more than 80%, right? Has the market appreciated from the pre-pandemic period to post-pandemic period by 80%? The answer to that is no. We were at around 12,000 index levels pre-pandemic, 11,500, let's say, give or take here and there. From there, have we appreciated by 80%? This is an absolute growth in profits, right? We have not, right? So from 12,000, if let's say we would have added 80% growth and let's say 9,600, we should have been at 22,000 index levels. We are not there. We are at 17,500. We are 20% below 22,000 index levels. Just by going by these profit numbers, because profitability has grown by 80-85% compared to pre-pandemic levels. But the market has not appreciated that much, right? So that does indicate there is a fundamental strength there, and there is still a lot of room for growth in the market, is what this indicates. Index ROE, again, we are reaching a decadal high in terms of index ROE, right? Look at the chart, right? So Nifty ROE, we're reaching a decadal high. Mid cap, small cap, NSE 500, everything put together, we are at a decadal high. ROE 3 years versus this, metals, 3-year ROE better what it was 3 years back. Right now, IT better, PSU banks significantly improved. Across the board, the return on equity of sectors has improved manifold. That's a very, very strong indicator of the financial health of the system. Makes businesses more viable. It makes profitability more viable. It makes sustainability of the businesses far, far greater if ROEs are significantly improved. What has also happened is, this is what I was telling you, FIs actually have sold a lot. So if you look at FY 19, FY 20, 21, 22, 23, 5 years put together, what is the total FI money which has come in, right? $40 billion came in. They pulled out $27 billion out of that. So we have just seen an inflow of around roughly in the range of not even 40, less than, yes, somewhere in the range of $40 billion in the last 5 years. And we have seen an outflow of close to $27 billion. 40 minus 27, $13 billion is just the inflow in the Indian markets. And before that, also, it was not very, very significant, right? If I go back from FY 16 to, let's say, FY 23, I look at a 7-year period, the number will probably be $17, $18 billion, right? It's not a very large number from an Indian market perspective. So eventually what's going to happen is the FI outflow will also reduce. So we're already seeing a reduction in FI outflow, right? From October 21, for 9 months, we saw consistent outflows. July was the first month where we saw some bit of inflows. August, September, that continued. October was a mixed bag. But roughly what I'm trying to say here is, the outflow has actually happened a lot, right? And the inflow has not been very, very significant. So there's a lot of selling which has already happened. And considering the fundamental improvement that I've talked about, we should see more inflows happening at some point in time. That should lead to better returns in the market, right? So FI outflow should stop because not much has actually come in. And essentially, outflows, if stops, then we should start seeing, because domestic institutional investors have been buying consistently. Look at FY 22, $29 billion, FY 23, already $20 billion. Right? So FY 20, $18 billion. It's the domestic institutional investors who have been buying it. That strength is very, very strong. Volatility index, as I was saying, is at a long-term average, so nothing really to worry about in terms of, so this is an index which is where it indicates the smart money is moving in, and this is the time where smart money comes in at these levels. It's an index level which spooks the not so courageous investors, and it's the smart investors who actually are able to take risk in this kind of market. In terms of our correlation with global markets, we are at 93%. So essentially, we are not decoupled from the global markets. We are outperformed the global markets. That's the important takeaway here. We are not decoupling, we are outperforming. So outperformance essentially means that what is happening is that in the Indian equity markets, the flows, the outflows, all those things are getting properly balanced out. It's not something which is driven by unforeseen forces, which could have, I would say, that tilted the market or made the market very, very risky to a huge sell-off happening, right? So correlation is high. So we are very much in line with global markets because we are at 90% correlation. We are outperforming because of the inherent strength of our market, and more importantly, also of the domestic strength of the institutional investors, right? So these are factors which are having a good amount of impact on the market. We see a lot of these factors sustainable, because of which this outperformance in the Indian equity markets is very likely to continue. Also, some of the factors for US markets, US market cap to GDP ratio is right now 163%. It's coming down to average levels. P ratio is coming to average levels. 12-month forward P at average levels. 12-month forward price to book is slightly above mean. right? So again, global markets are also coming down to average level. So India is actually, interestingly, price to book is mean, which is a more fundamental ratio. Price to earning is slightly above mean. So if you look at India versus the US market, right, we are on a more fundamentally sound footing actually, because price to book is a more important ratio and it's a more stable ratio. We are mean on price to book when we are at slight premium on price to earnings, around one standard deviation or versus long-term average. So that means that essentially there is more ability in our book value to generate higher earnings growth. That's the indication. So overall, we are quite well set up. In terms of what has happened in terms of the results which have been out, there are more results which are coming out. This was updated a couple of days back. So 8 results are out among Nifty 50. 3 have beaten estimates. 3 are in line, 2 have missed. So essentially, we're still doing very, very well on the results front. We're still doing very, very well on the results front. That's something which is very important right now. So that's it from the overall market perspective. I'll just talk about our managed accounts or our PMS strategies. At Axis Securities, we call our PMS strategies as our managed accounts. We offer two strategies. We offer Axis Pure Contra and Axis Pure Growth. These are the two investment styles we offer. Pure Growth essentially is an investment style where we offer growth and quality as the two main frameworks of our investment style. And it's essentially a small cap, mid cap, and multi cap strategy. Small cap and mid caps do dominate because that's where the earnings growth is more stronger. If you look at the portfolio, it's a mix of small cap, mid cap, and large cap. But of course, a great amount of emphasis is on small cap. We look at quality companies. We look at companies where there is sustainable earnings growth. We shy away from cyclicals. We try to shy away from PSUs because PSUs are more value plays than growth plays, right? So, but there are enough ideas to be found in small caps and mid caps which can generate very strong returns. So if you look at a portfolio of very high quality companies, look at, we have good healthcare, we have chemical companies, we have good amount of industrials, like even like place like Linde India, which is a green hydrogen story, right? We have consumption companies like Varun Beverages, right? Healthcare like Narayana Hrudayalaya. These are all sectors which do very, very well in the long term and generate good returns. In terms of performance, very strong performance. On 2 years basis, we have generated an alpha of 7%. This is after all the costs. 1 year basis, we are at an alpha of 9%. We have delivered positive returns in the market when the market was negative. On 1 month basis, 3 months basis, 6 months, every perspective you look at it, we have beaten the benchmark by a good margin in this. Then is our pure contra strategy. Pure contra strategy is hinged on 3 factors, which is value, momentum, and special situations. Value, of course, as an investment style, delivers non-linear performance. Momentum, of course, is one of those styles which has delivered astounding returns for investors for a very long period. And special situations delivers that absolute return and absolute alpha, right? In terms of our strategy, stock selection, we look at anything where we can extract value. So there is a good allocation to PSUs, like we have PSU banks, like State Bank of India, Bank of Baroda, Baki is our largest allocation in this strategy, right? We have wide range of companies ranging from, let's say, Newland Labs to KDDL to even, let's say, ITC to CSE investments. So wide range of ideas in this. Wherever we can extract value, wherever we can make money. Again, terms of returns, very, very strong. So 2 years alpha is 14%, right? 2 years alpha CAGR is more than 14%. 1 year alpha is more than 7%. 1 month alpha is 4%. 3 months 5.2%. 6 months 5%, right? Across the board, we have generated good alpha since inception, which was June 2020, delivered a more than 16% alpha over the benchmark. So very, very strong returns from the strategy. So this is the performance of pure contra. So you can, so in this latest investor newsletter of PMS Bazaar. Both the strategies have been covered in depth. Even the portfolio construction methodology has been covered in depth. We have even provided the attribution analysis of what has resulted in this kind of returns from our strategies. Everything has been covered in detail, so you can go through the investor newsletter to understand more about our strategies and learn more about our strategies. And also you can invest in our strategies by contacting us, right? So if you have any doubts, please write to us. We will be more than happy to provide clarifications on our strategies. So that's it from me. I'll leave it at that. I would ask Akshara to start the Q&A session. We can wait for the question.
Thank you. Thank you. I need to thank you for this wonderful insight, for the wonderful webinar. We have a set of questions to ask you. So first, I would like to start off with Mr. Aditya, who had asked the first question. As a retail investor, do you think the portfolio that is constructed with market cap weighted better or EPS weighted better? So your answer on that, sir?
Yeah, so I'll tell you what, the way that we look at it. So we look at more of multi-factor models from a market perspective. So market has various, so market is influenced by a lot of factors, which are essentially you look at market from a perspective of where macroeconomic events like interest rate cycle, how the domestic economic cycle is behaving. All these have a very, very strong impact on how the various equities will behave, right? If interest rates are moving up, a set of stocks will do well. If interest rates are coming down, a different set of stocks will do well, right? So there is no clear-cut answer whether X-weighted market cap stocks will do well and a small cap will do badly and large cap will do better, right? There is no clear-cut answer between the two. I would suggest that you have to look at more from the perspective of what our objectives are from a long-term perspective. If we are looking at a portfolio which is intended to generate compounding long-term returns, right, then we should look at growth stocks and quality stocks, right? So these are stocks which will deliver good returns from a long-term perspective and will deliver compounding returns, right? If you want to take a little less risk, we can look at more of growth stocks with a large cap orientation. That can be a theme to look at, right? But it might be the case that these stocks might deliver returns which are lesser than the market. That is a possibility. But however, what will happen is that if you hold them for sufficiently longer time frame, they will deliver returns which are better. On the other hand, you are somebody who is a more risk taker. You like taking risk in the market. You are okay with booking losses, right? You are okay with changing your orientation. You are okay. You are experienced investor or a trader. In that scenario, you can invest even in cyclical stocks depending on how the market is behaving, how the market is moving. If you see an earnings momentum playing out, but you should be willing to churn the portfolio. More importantly, if you are willing to cut your losses, then your strategy style should be different. So short answer is there's no clear-cut answer between weighing on market capitalization or weighing on earnings growth. Earnings growth is a good style if you are looking at a long-term strategy. But I would suggest that look at portfolios which are more based on what will do well in a particular environment, whether a growth will do well, whether a value can do well, whether a cyclical can do well, or a momentum can do well, right? Those are important areas, because if we are stuck with a certain idea that this is how it is going to be, it does not work. We have to be a little nimble in the market between toggling between various aspects. So in times there will be small caps which can do exceedingly well. Times there will be large caps which can do well.
Okay, thank you. Thank you for that. I hope, Aditya, your questions answered. So one of the other questions are, do you see bearish sentiment continuing in the equity markets in recent financial year?
So while talk about bearish sentiment, we are like 4% away from the all-time high, right? So So from that perspective, are probably 5% away. So 18th October 2021, we hit 18,477. So we are at 17,500. So there are quite a few stocks which have made new highs also. So I would not say we have too much of a bearish sentiment, to be very honest, because see, the 18,477 level was also a level which had a lot of exuberance in it. There's no doubt about it. Probably we should have been better off at 16,800 also last year. So my limited point here is that in India per se, we are not very bearish. Globally, of course, the sentiments are very bearish. No doubt about that, because inflation is not coming under control that quickly. Still, core inflation is inching up, but I think we are entering the last leg of the inflation challenge. Europe will still be very challenged, I feel. But US, I think, can come out of this sooner. So I think the bear market, there is actually a bear market. There is no doubt about that. I showed the numbers, right? So Nasdaq is down by 28%, S&P 500 post Diwali is down by 20% plus. So they are in a bear market. And bear markets last for a year or so, and then they recover, right? They don't last forever and ever. I think the party never goes on forever, and nor does the bear markets go on forever. So I think the US market should come out of bear market probably by January, February. And from our perspective, I think we are doing quite well, and we should continue to see our performance, as I've been making the point in my presentation. And we are not in a bear market, and probably by this year end also, there's a good chance that we might touch new highs.
Yes, everyone wish. And one more question is that for institutional investors, US bond yields are looking more attractive due to raising interest rates than volatile and risk equity. Will there be a big outflow from equity to fixed income from developing or Indian markets?
So the outflows, I think, have taken place, as we did point out. So there is good amount of outflow which has taken place already. I think the flow should start ebbing from now. It has started to ebb, right? So the 9 months we showed that from October to June there was an outflow. July we saw some bit of buying. August we saw some bit of buying. September was okay. October has been a mixed bag. So my limited point here is that the outflows are started to actually, the pace of flows has started to reduce. And I think where the currency is, probably the outflows could reduce further also, and we might start seeing inflows at some point in time. So that's where I am. I think the balancing act between the bond yields, I think that is happening already globally.
Okay, thank you, sir. There's a question from Arun. Will combination of all factors as a part of investment strategy may fetch balanced and consistent returns, right? Kindly share the numbers of growth and quality returns or vice versa factors, and any trending factors which are you planning to consider in upcoming months?
So I already presented our returns profile, right? Growth and quality put together. So every stock has these. So the way that we look at it is typically when we are looking at our factor portfolio and model. So it's not that one stock is only growth and one stock is only quality. There is a higher blend of these factors in when we are allocating, right? So if you look at our fact sheets, we also provide these things, right? So in terms of what is the bend towards these factors. So what is the how much we are actually looking at overweighing in terms of quality in these factors. So that's where these strategies tend to skew in one direction versus the other direction. As far as what is being considered for the next few months, so our larger theme is at this point in time, which is an arching theme, is essentially growth at a reasonable price. Reason being that at this point in time, if you look at where the market is, where interest rates are up, so it's an even balance between what one wants to buy. So one of the most success stories of the last 1 year is a stock like ITC, where it was a meme stock at one point in time. And right now it's been one of the most successful stocks in the last 1 year, probably a top performing Nifty stock. Reason being, ITC offered growth at a reasonable price. That's the biggest. I think ITC has outperformed all the FMCG stocks because other FMCG stocks are growth at any price versus ITC is growth at a reasonable price. So there is a bend towards growth for sure. But if I can combine growth with a reasonable price equation, I think the chances of outperforming are very, very large. And that's what we are banking on. And of course, quality as overarching theme can also work well. But I think growth at a reasonable price is a very good theme to play out.
Okay, sir. Thank you. I hope, Arun, your question is answered. Moving on, I think the one common question that every fund manager gets is this. With the growing concerns of recession in Europe and US, how much will it affect Indian markets in the next 2 to 3 years? This question is from Samir.
Yeah, so if you look at recession as a challenge, actually, most of the impact happens in the equity markets before the actual event happens, right? So that's one way to look at it. Second way let's look at it this way. If we actually see the exports number till March, they were very, very strong. Exports have actually come down also, even though currency is up. Exports have come down. So there is already an impact of whatever you want to say, whether US and Europe are in a technical recession, they are in an actual recession, they will be in an actual recession 12 months down the line. There is no clear-cut answer to these questions. But what I can say is that there is a challenge in those markets where the real growth is missing. So what we are experiencing, I think, is a recession kind of a market in developed markets, right? The way IT stocks are corrected, oil and gas stock will probably build in a 10% recession chance, but the IT stocks have built in a 90% recession chance already, right? With a 25% correction. So that's where we are. How it will impact the equity market impact typically happens earlier, then it changes. So from that perspective, we have already seen the impact. When the recession actually happens, we'll have to wait and watch out what happens in terms of bond markets and other things and currency. I think that will be the factors to watch out for. Because if there is a recession, the rates will start coming down. And then currency in India will also stabilize. As far as the equity market challenges are concerned, I think that would have taken place, which I think most of it is played out. So maybe another quarter or so. So just to answer this question in a short manner, I feel we already witnessed the impact of recession in the equity markets, both in globally as well as in India. But when actual recession were to happen, I think that's when the rate pause will happen. Many things will start happening. Currency will stabilize. Appreciation might also happen to rupee. So all these things will start being probably from a stock market perspective might be not so bad actually.
Okay, thank you. And where do you see value sector-wise? So
yeah, so as I indicated, banks are a clear-cut winner, no doubt about that. The ROEs are touching close to all-time highs. While I work with Axis Bank as an employee, I can't talk much about Axis Bank, but still I can't hold back and say the yesterday's numbers. If you see, Axis Bank also reported an 18.9% ROE, right? So from that perspective, if you look at it, we are in a very, very strong trajectory for banks in terms of profitability, in terms of balance sheet strength, everything, right? So that's a very, very strong indicator, and these are all very, very helpful factors. So banks are, of course, very, very strong to be, look very, very strong to be. Then, of course, there are areas which are very, very interesting. Defense as a theme is very, very interesting to us because of multiple factors, procurement, by not just Indian government, by other governments. So that's a very, very interesting theme to look at. Industrials as a sector is seeing good tailwinds. Order books are full. So there can be good turnaround stories to look at even in industrials. Then consumption as a theme is a good theme to look at, both consumer discretionary. Hotels are doing exceedingly well. And lastly, the dark horse could still be the IT sector. If one more quarter down the line, if we see orders don't, order flows are fine, and I think for them, the new batch of employees will be ready. So churn will come under control, cost structure will get managed better. I think IT could still be a good sector to look at from another quarter perspective. So these are the areas that we are keenly watching.
Okay, thank you, sir. Sanjay Nayak has a very good question to ask. Which is your favorite book on investing?
So to be very honest, I don't read so much of investing books per se, but I like to read books which help you to think about investments, right? So that there are, I will name two books. Okay, one book is a book called Think Fast, Think Slow. So essentially, it talks about what are the situations where you should be taking decision quickly, and where you think you need to think fast, and what are the situations where you should be thinking a little slowly. So it talks about two, three things. One is data is not very intuitive. Probabilities are not very intuitive. Markets work a lot on data and probabilities. Both these things are not very intuitive to human mind, right? So what think fast and think slow does is, you should be able to essentially look at various situations and take decisions in a manner which requires a certain stepping back or taking decisions in a faster manner. That's where it helps. And I think it's a great book. It's more of a book on psychology, but it's a great book for investors. Second, of course, is a book called Super Forecasting. Super Forecasting is a very interesting book. Again, it's written by a Wharton professor. It's a book on how to forecast, right? It's not about forecasting about equity markets, but it's just about forecasting. What makes you a better forecaster? So the book makes a very interesting point. There are all these superstar people in the market who talk about being very good at forecasting, but actual statistical numbers show that they're not very good at forecasting, right? It's somebody who is, it does not take a huge intellectual capability to be a very good forecaster. It just takes a little bit of tenacity and being open-minded to be a good forecaster. That's it. So that was an eye-opener to me. Typically, we as investors, or we are as fund managers, it's not about getting one big call right, which would be a multi-bagger. It's about making 20 decisions right in a year, where we are able to save money in X number of stocks and probably make money in these many stocks. So the idea is not about getting one story right and telling that to people and making our name, right? So it's about more ideas getting right. So these are two books which I think in conjunction work extremely well. Both basics essentially talk about being more open-minded, looking and searching for data, being more thorough about your job, and essentially finding spaces which are completely unbiased, right? So that's what essentially helps you to do a good job. And these are two books which I think are very interesting to read, that can change not just your investment philosophy, but that can help you in life also.
Okay, thank you, sir. I'm sure the person is going to read it today. And yeah, the macros of, as you said, the macros of India is finding its stability. I need to ask this one question. What are the near-term challenges you think India would face, and to make it as a fast-growing nation?
See, the biggest challenge right now that India is still facing is with regards to, see, of course, the currency in India is at this point in time is a problem. India's credit rating from a global perspective is a problem. We actually have, I don't see when we have defaulted. I don't remember also, right, in the last 50 years, but There are countries who default have a higher rating than India. I don't know why. So India should have a much higher rating, right? So that's essentially is a very critical factor. So these are small factors which are very difficult to make sense of why our global credit rating is not that great. And these are small challenges which I think need to be tackled. So these are aspects. Of course, then India as a whole, of course, we have our own set of challenges. We are not secure energy-wise, which is a challenge. Crude goes up, it sends shivers down our spine. There's no doubt. So crude going up to 150 is a nightmare for us, right? If crude were to go up to 150, it will be a nightmare. There is no doubt about it. So those are challenges which we tend to worry about. That gives us not just us, the government, everybody sleepless nights. So how do we tackle? How do we make ourselves more energy secure? Those are going to be the big challenges for India to become, let's say, a $10 trillion or a $5 trillion economy. We will become by ourselves. I don't think so. That's something which is, but $10 trillion economy that India wants to become will need to be more energy secure. We need more renewable. We need to be doing a lot many things, which I think on the energy front, which will be very critical. There are things which are happening. How fast they happen, how policy making happens in that on that front will be very important. And then, of course, we have to get our credit rating up, right? These are factors which are sort. I think we will be in a great shape.
Fingers crossed. And yeah, with said that, it's a follow-up question. What are the safe or have sectors that you think at this point of time, like apart from energy?
Yeah, so in India, consumption is a fairly safe sector. There's no doubt about that. Banks are fairly safe. So whether we look at the top notch private banks or let's say the public banks top notch, I think they are fairly safe bets to take in this kind of market. Consumption, we have a wide range of names that you can think about, which the chances of losing money have been fairly limited in the past. Right now, also we see that these areas may not lose money. Autos, of course, are a little more cyclical in nature, so we need to be a little careful. But but I think we are in a good model cycle there also. So chances of us making money in that sector is also good. So I would say that consumption, banks, some degree autos, industrials are a tough pick, to be honest. But I would say that these are safe areas. And lastly, as I was talking about, companies with strong balance sheet, if you can study balance sheets, I think that can be a very good thing. Debt-free companies with good balance sheet and no major working capital challenges. If you can figure those companies out by yourself, I think those are very safe bets.
Thank you. I know you're very positive on India. This is like, how do you perceive India's macro position in global context? How do you position India globally?
Yeah, so that's what I was talking about some time back. So India is very strong from a macro position point of view, because I don't see growth anywhere, right? So everywhere the challenges are very huge, especially in the Western world. The challenges emanate from these factors, right? One is there is a major challenge of labor. Labor participation rate post-pandemic has gone down. That's not a challenge with India. Inflation, we have to break it down from in terms of expected inflation and unexpected inflation. India 7% inflation is something which we expect. We live with it, right? So it's not in 2011 to 2014 time frame, we saw double-digit inflation consistently, and that was very persistent. We never thought that world is going to end, right? So that's the thing. Whereas in Europe and in US, 8% inflation is something which is numbing. So those are aspects. So, and apart from that, we use thermal energy, so we are okay. The price of that will be managed. So those are factors where I think India is quite strong. We are one of the largest economy, which is growing probably at 6-7%, and which is sustainable also. Such a large economy growing at 6-7% is a rarity, and that's what we offer. So we are very well placed in the global context.
Okay, thank you, sir. There's one more question from Abhishek. what is your take on pharma, especially API manufacturers, given they have corrected a lot and China plus one is still to be played out fully?
Yeah, so the API manufacturers per se, so those the prices are very, very difficult to predict, right? So my sense is that I will still avoid the API manufacturers because it's more of a commodity play. If it's a specialized kind of play, then we can still look at it, which is it's a specialized chemical kind of a play. What Sun Pharma is getting into in increasing its wallet share. That's something which is interesting. Other area which is a good area to be is the CDMO, which is contract manufacturing, CMO space, which is, let's say, the likes of Divi's or a Suven or a Newland or a Laurus. I think these are still fine. I think these are companies which might still report good set of numbers. They're seeing good traction. So those are areas which I think are still can do well. So that's those are the areas that we like.
Okay. Thank you, sir. With this, we'll come to the last part of the Q&A section. The last question is, okay, we've spoken about India's macros as well. So what do you think the recession, if it comes to developed markets, can delay the CAPEX recovery in India?
So recession in the US leading to delay in CAPEX recovery in India. Is that the question?
Yes.
So recession in the developed markets has got nothing to do with CAPEX cycle of India, right? So to some extent. So CAPEX cycle, if you look at in India, the CAPEX cycle is threefold. There is the public CAPEX, which is the government's CAPEX. Then there is the private CAPEX or the private corporate CAPEX. And the third is the individual CAPEX, which is, let's say, building of houses and things like that. So the US recession will not have an impact on either of the three. Maybe to some extent there might be some private CAPEX cycle because there is the FDI which might slow down. So that's the only area which I can think of where there can be an impact. But if we look at, let's say, the kind of investments that we are going to see in India over the next decade or so, companies are turning inward, right? So just to give you an example, let's say Tata as a group, the largest conglomerates in India. So over the last 2 decades, they thought of actually going more and more global. They invested in JLR, they bought Chorus, right? That was in the decade before that. Their experience has not been that great, honestly speaking. Then, of course, their bellwether company, which was TCS, which was again a more of a global play, right? Which is exposed more to. But on the other hand, they are seeing companies like Titan, Tata Chemicals, the Tata consumer products of the world doing very, very well, right? On the other hand, and then of course the other range of companies. So the short answer to this question is now they have also turned inward. They are looking at a $90 billion CAPEX cycle over the next 10 years. So I think that thing is going to continue. Reliance, of course, is announced big. Adani is doing big in India. So again, the largest houses are now betting more on India than probably the global CAPEX. So when it comes to doing business, I think people are now focused that let's do business here because we understand our country better. We know the system well. We know how it works. We know the nuances of the system, and that's what we will. So I think that can still continue. So that may not be impacted by the global forces.
Thank you, sir. With that, we have come to the end of the session, end of the webinar. I want to thank you for saving up your time for us, as well as the participants who have joined and who has been traveling with us all along.